Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Hess Corporation, ticker symbol HES. So we're looking at the business today as a subscriber request. Hess has been one of the top performing companies in the stock market over the past year. Currently, the business is trading for $146.59 per share. And over the past year, their stock price is up 57%. We want to analyze the business today to understand what are we missing? What could the market have possibly discovered about this business this past year that's led to this kind of outperformance? So over the last 5 years, Hess is compounding at a rate of 27.5% annually, which has been massive growth for the business. Their stock price is up more than 3.5 times over this period. Over 10 years, their compounded annual returns come back down to earth. They're compounding at a rate of about 8% annually. And going back prior to the global financial crisis, over the last nearly 18 years, Hess Corporation has compounded their stock price at a rate of 9.5% annually. Keep in mind that the company also does pay out dividends, and currently they're paying out about a 1% dividend yield. So their average dividend yield throughout this time frame would be in addition to this compounded annual return. So Hess is currently trading about $14 below their 52-week high. They're up about $60 from their 52-week low. Hess has just under 2% of their shares outstanding currently sold short, and they're a very large business. They have a $45 billion market cap. So for additional background about the company, Hess is an independent oil and gas producer with key assets in the Bakken Shale, Guyana, the Gulf of Mexico, and Southeast Asia. At the end of 2022, the company reported net proven reserves of 1.3 billion barrels of oil equivalent. Net production averaged 344,000 barrels of oil equivalent per day in 2022 at a ratio of 72% oil and natural gas liquids and 28% natural gas. The company was incorporated in 1920 and is headquartered in New York, New York. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Hess based off of their business fundamentals. So this is an evolving and improving process, and it also serves as an opportunity to learn in public, so this analysis will continue to get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the typical publicly listed business earns about a 7% return on capital. So by asking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Hess, as an oil and natural gas exploration and production company, is going to see their returns on capital fluctuate with the pricing of those commodities. So as the price of oil went negative in 2020, and then as it has steadily rebounded since, Hess has also seen their returns on capital go negative in 2020 and then steadily rebound. So while the business is earning returns on capital that are well above those of a typical business in their most recent fiscal year, on average over this period, Hess is only earning about 5.5% returns on capital, meaning that these returns are slightly below those of a typical business. And so this is an X to start things off on metric number 1. As their returns on capital are falling short of a typical business, let alone that 14% benchmark we were looking for. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric is going to be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time, Hess has grown their revenues by more than 80%. Their revenues have more than doubled from 2020 until 2022 alone. Their net incomes have also gone from being negative from fiscal 2018 until fiscal 2020 to now they've been positive in 2021 and 2022. And that was the same thing for their free cash flows. The business has been producing positive free cash flows in both 2021 and 2022. But they had negative free cash flows for the 3 years before this, meaning that this is strong growth for the business. The business is now bringing in more revenue, actually has positive earnings, and is actually producing free cash flows. This is our first check of the day coming in here on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Hess on a per share basis. So we're looking for earnings per share growth over the last 5 years. Their earnings over this time, again, have swung from being negative to now they're positive, so the business is actually bringing in money. However, earnings are just one part of this equation. However, we still want to look at what the business has done in terms of their shares outstanding. Hess over this time frame has slightly diluted existing shareholders in the business. They've issued about 4% additional shares outstanding. That is slight shareholder dilution. It would seem to be the case that it's more important that the company is now producing positive earnings. And because of that, their earnings per share are up over this period, and this is another check here on metric number 3. Next up, metric number 4 is going to be very similar. So here we're looking for free cash flow per share growth over the last 5 years. With almost the exact same story as their earnings, this is going to be a check here on metric number 4, as their free cash flows have swung from being negative to now they are positive. And again, the company has slightly diluted their shareholders over this time frame. Next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over the last 5 years. Hess has been paying down their net debt position. They took on a maximum of $7.3 billion worth of net debt in 2020. Currently, they have about $6.7 billion worth of net debt, so they still do have some room to pay this down. Net over these last 5 fiscal years, because the company has had negative free cash flows in 3 of these years, the business has only produced $153 million worth of free cash flow over this time. So that's a very tiny amount relative to the net debt that they're employing in their business. So this is an X here on metric number 5. Again, though, the company has produced $1.2 billion worth of free cash flow in their most recent fiscal year. If we were to extrapolate that out over the next 5 years, it still would look like the business is just slightly over-levered compared to their abilities to produce free cash flows. This may or may not be a potential concern for you as you're looking at Hess. If you are interested in learning more about their debt profile, you can dig into the company's filings and they'll break this out in more detail, where you can understand how this debt is structured, when it matures, and what rates it's at. So to recap where we stand currently, through our first 5 metrics, we have 3 checks and 2 X's for Hess. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially offer us a reasonable starting point for evaluation of the business, and potentially give us a slight risk premium to the yield of the 10-year treasury. Hess currently has a $52 billion total enterprise value, and we're using their enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the business that's more similar to as if Hess were a private company. Again, because the business had small net free cash flows over the last 5 years, their average free cash flow to enterprise value yield is just going to be tiny here relative to their total enterprise value. So this is going to be an X here on metric number 6 without even running this calculation. We do want to look at their current free cash flow to enterprise value yield to see if that can help us give a perspective of the business here. In our previous metric, we learned that Hess has produced $1.2 billion worth of free cash flow over their last 12 months. So to get a current free cash flow to enterprise value yield for the business, when we divide their $1.2 billion of their last 12 months of free cash flow by their $52 billion total enterprise value, that only gives us about a 2.3% current free cash flow to enterprise value yield for the business. So even on a basis of their current free cash flows, this is coming in less than half of that 5% risk premium we're ideally seeking, and this is below the yield of the 10-year treasury as well. It doesn't look like Hess would be offering that potential risk premium that we're ideally seeking, and so again, this is an X here on metric number 6. Just because this is the case, though, doesn't mean that you're going to throw this business out in its entirety. This is not a buy or sell recommendation of any security. This is one of our 6 metrics, and while these metrics are simple, when they're combined together holistically, they can be very powerful. Plus, we've still got some interesting aspects of Hess left to cover. Then here, as a bonus, we're taking a look at Hess's dividend profile. So right now, Hess is paying out about a 1% dividend yield. Over this time, we see some potentially questionable capital allocation decisions, as the company had negative free cash flows in 3 of these 5 fiscal years, but they were still paying out dividends. At the same time, however, the business was taking on debt, but they did have low returns on capital, especially relative to other businesses. But it's likely the case that management could have found a better opportunity for these free cash flows. These dividend payouts were coming from some other means other than the business's cash flows, either coming from the sale of assets, raising additional debt, using up the cash on the business's balance sheet, or from issuing new shares. So using the business to do that and pay out dividends is likely not a prudent capital allocation decision. That's likely something you'd want to question here, especially as you're doing the work to understand both the character and competence of management, especially when it does come to things like capital allocation, as the business is heavily involved in the recent expansion off the coast of Guyana. Since the price of oil has risen post-2020, however, the company has produced more than enough free cash flow to comfortably pay out their dividends. Again, though, because of their higher debt loads and their sporadic free cash flows over these last 5 years, if you're interested in the long-term future of Hess, again, depending on the exact details and the structure of their debt, the business may be better served here by retiring some of their debt going forward into the future, rather than paying out some of these dividends. That may or may not necessarily be the case, but you'd be able to learn more about that and come to a reasonable understanding for yourself by digging in and learning more about the business. Then everything we've learned so far is important, but there's something missing that in my opinion is the main reason to analyze Hess, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Hess. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. Here we're starting with the business's current free cash flows and using historical growth assumptions dating back all the way till 1990 for how the business has grown their free cash flows over time in order to project these out into the future. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions are going to be accurate and applicable going forward for the business to give us that baseline projected estimate over the next 20 years. So if we assume that Hess can grow their current free cash flows at a rate of 5% annually over the next 10 years, and then these free cash flows grow at a rate of 4% annually for the 10 years out after that. If we add in the company's tangible book value, which gives us an approximation of the tangible net worth the company has per share, and if we were ideally seeking a 15% rate of return from the business, which is the rate of return that Warren Buffett is looking for from his investments, then it looks like a fair value for Hess at today's valuations of the company is right around $60 per share. So that's significantly below their current stock price, and it looks like, according to this, that the business would not have a margin of safety in it, and it looks like the business would be trending toward more overly valued. Please keep in mind a major caveat here in that a discounted cash flow model is based off the predictability of a business's future free cash flows. So because Hess is an independent oil and natural gas exploration and production company, their future free cash flows are going to be heavily tied to the pricing of those commodities. Historically, oil and natural gas have been cyclical industries, where the industries have encountered huge periods of excessive capex and then huge periods where capex is really starved from the business. This has led to these boom and bust cycles over time. Over the past 10 years or so with U.S. shale production, there was quite a large amount of capex that was going into the industry. Since the COVID-19 pandemic lockdowns, however, there has not been a lot of capex that's been going into the industry, with many of these oil and gas companies prioritizing returns to shareholders and profitability. So in order to understand Hess's future free cash flows, you're just going to need some sort of insight into the business and some insight into the industry as a whole. If you're interested in learning more, one resource I can recommend is the Value Hive podcast episode, where Rory Johnston was the weekly guest on the podcast. He provided an excellent overview of the oil and natural gas industry and provided a tremendous number of high-quality resources to go out and learn more. So that's something you can check out if you're interested. But again, please be mindful that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for Hess Corporation, but we have to address something first. What are some of the qualitative aspects of this business, especially those that support the key points for either a potential long or potential short thesis of the company? So starting with some of the key points around a potential long thesis for the business. Number one, Hess's activity in Guyana provides geographic diversification and insulates it from domestic issues like infrastructure constraints or the threat of anti-fracking regulations. Number two, due to the scale of prize and supported by favorable fiscal terms, Guyana supply costs are well below the global margin cost threshold and competitive with the best shale resources. The Stabroek block in Guyana, in which Hess has a 30% stake, is a huge resource with at least 11 billion barrels of oil equivalent recoverable. It will account for about 2% of global oil supply by 2030. Then for some of the key points around a potential short thesis of the business. Number one, Hess's Bakken footprint includes peripheral acreage that may not generate the same stellar flow rates that the firm is currently reporting. Well performance deteriorated in 2022. Number two, Hess's Guyana assets offer similar returns to the best shale fields, but the capital requirements are heavily front-loaded, dampening the cash generation potential for years to come, and potentially precluding more generous shareholder distributions. And number three, Liza was sanctioned at a very fortuitous point in the cost cycle, and finding and development costs have been steadily rising for follow-up developments in Guyana. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects of the business. Now it's time for our wrap-up. So in summary, Hess Corporation checks the box on 3 out of our 6 metrics. The business is earning below average returns on capital, although they have earned above average returns on capital since the price of oil has rebounded post-2020. Their revenues are up 80% over the last 5 years, and both their earnings and free cash flows have gone from being negative to now they're positive. The business has diluted existing shareholders by about 4% over this time frame, and even though the company has paid down some of their net debt position, because they were cash flow negative in 3 of these 5 years, they have just a very small net amount of free cash flow over this time. Even when we extrapolate their current free cash flows out into the future, it doesn't look like those would be able to support the business's debt loads, and it doesn't look like they're attractive relative to the yield of the 10-year treasury either, as they were not giving us that risk premium we were ideally seeking for the business. So it looks like Hess's current stock price reflects a lot of the built-in future assumptions for how the business will perform related to its activities in Guyana. Looking at the business's dividend profile, we also can see some potential questionable capital allocation decisions as they were continuing to pay out dividends even when they had negative free cash flows and the business was raising money. Then finally, performing a discounted cash flow analysis of Hess Corporation. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward for the business over the next 20 years, and you are ideally seeking a 15% rate of return from Hess, then from today's valuations, it looks like a reasonable fair value for the business would be around $60 per share. So the business was last at those levels in February of 2021, although their current stock price is more than double this. So again, there are reasons why that may not be potentially accurate for the business, so it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Hess. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand its ins and outs and understand what's important and what's not important for the company going forward. So as you conduct this research, you'll learn more about the qualitative and the quantitative aspects of the business, and you want to learn accurately, completely, and then go back and ask yourself, what did you miss, in order to understand the underlying essence of the business and likely be able to come to a reasonably appropriate intrinsic value for Hess. So with that said, that's it for today's fundamental stock analysis of Hess Corporation, ticker symbol HES. We looked at the business today as a subscriber request and because it fits with looking at some of the other oil and natural gas companies that we've covered. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Hess with me, and have a great day.